Market trading on Friday, the same day the president was moved over to Walter Reed. The S&P 500 index decreased by about 1%, while its volatility index increased by 3.5%. So what do you do? Joining us this morning, Jeff Anthony with Wild Health Management Group. Jeff, we want to say good morning to you. What is driving the market for the most part? Because there are days when the news is bad, but the market doesn't seem to be close to reality.
Hey, Scott, thanks so much for having me on. I appreciate it. You know, a lot of there's a lot of data that's been coming out with us, depending on whether it's, additional stimulus packages or earnings or virus cases. So I think a lot of what has kept the markets up right now has just been the government intervention, low interest rates, to kind of get us through this right now.
Well, I want to ask you about some do's and don'ts, but 1 month out, basically, from the election, what are we going to see with the market, do you think, and possibly if another president gets voted in?
Right. So we have this conversation with a lot of our clients right now. So recent event as far as like the elections coming up, we've looked back at the last 120 years of just elections going through or elections during that time period. And regardless if it's a Democratic, Republican, split Senate and House, it really doesn't change the outcomes of the markets. They've had positive outcomes for that. So what we like to tell our clients is you want to make sure that you stay the course. Make sure that you're comfortable with your portfolio that you're with, because, I mean, we're definitely going to see some volatility around the election time and even possibly before that, depending on if we get additional stimulus packages coming out. So I tell people not to focus too much on short-term things that are coming through, just because, in 6 months, we're going to be on to the next subject.
Well, obviously, it's good to have a professional like you handling a portfolio. But for people doing it on their own, one of the things that you like to say is don't have a herd mentality, in that don't do what just everybody else is doing.
Yeah, exactly. I mean, one of the biggest things you want to look at is when you look at what everybody else is doing, everybody might have different time horizons or different risk tolerances that you are doing. They've actually have investment philosophies about doing the opposite of what retail investors do. So one of the things I would say is make sure that you are investing properly for your time horizon. So people that are doing it on their own, if you have liquidity or need that money within the next 12 months, now would be a great time to maybe raise some cash and take some of the profits that you have off the table.
And one of the other things with there's so much volatility out there, you can have a good day and you can have a bad day as far as your 401k, but I think you want to tell people don't get so upset on the day-to-day losses.
Yeah, absolutely. I mean, it's okay to check things to make sure that you're still on the right track with where you want to be as far as your retirement goals. We spend a lot of time with our clients, building financial plans and making sure you want to make sure that you're checking and hitting milestones along the way. But that doesn't mean checking your accounts every single day. So I think probably checking once a month or once a quarter is probably sufficient if you're allocated properly or having somebody else do it for you. But I would tell you, tinkering with things and getting in and out of markets. One of the really interesting statistics that we found is they've done studies over the last 20 years on the S&P 500. And if you miss the 10 best days in the market over a 20-year period, it cut your return in half.
In half. Wow, by 50%. That's pretty substantial. Thank you so much for your time and good luck to your portfolios.
All right. Thank you. You too.
All right.
Thanks,
take
Scott.
care now.